Your market news now, global stocks and commodities slipped after data showed the Chinese economy is growing a lot more slowly than expected, while the dollar eased as traders ramp up their bets for an imminent end to U.S. rate increases. Shares in mainland China were the worst performers in Asia. Japanese markets were shut for a holiday, while trading in Hong Kong is cancelled due to a storm. Meanwhile, this week's macro calendar is light, and Fed officials are now in their blackout period ahead of the July policy meeting, leaving investors with the big question of whether last week's market moves will continue or reverse. Locally, Anglo-American Platinum said its first half profit is likely to fall as much as 75% due to lower metal prices and after power outages and a smelter rebuild cut sales volumes. To give us more perspective, we are joined by Bright Khumalo from Vestec Asset Management. Bright, thank you so much for your time. The kind of picture you're getting when you look at markets right now, given this backdrop of China's GDP figures coming in a little bit lower than expected.
Yes, overall global market, the sentiment is still very positive. This is after obviously the US inflation data we saw last week, Wednesday, and then the PPI numbers that came on Thursday both numbers showing that they're cooling. I'm not sure why we're excited that PPI is cooling, because that's never a good thing, really. But yeah, so that's what has helped sentiment lately in terms of saying maybe because inflation is cooling and production is cooling, the Fed wouldn't have to be as aggressive when it comes to those remaining interest rate hikes. So they're gonna basically there's no longer going to be runaway inflation. Instead, there will be sort of a soft landing.
I was going to ask you on that soft landing narrative or that discussion. Where are you at this point? Are you convinced that the Fed might actually engineer the soft landing that we've been talking about since last year? And also, where's your base case for that recession that we've been looking out for the whole of this year?
I hope they are successful in achieving that soft landing or, the happy medium. Because, it's going to be very hard to increase interest rates without losing any jobs in the labor's market, which is, contradictory theoretically and, in real life. You can't increase inflation and expect people to stop spending if, they still have all of this money from, all their jobs. So naturally, according to the Phillips curve, they've got an inverse relationship, labor and interest rates. So you are expecting to see some bodies, when you're very aggressive in trying to target inflation. In terms of where I am, I don't know. I'm an investor. I'm a long-term investor. So this is merely a short-term blip, in what's going to happen in the next 10 to 20 years, which is what the type of horizon that we look at as long-term investors.
So last week, Friday, we had three of the U.S. banks, unofficially, so to speak, kick us off when it comes to U.S. earnings. Your overall sense of the numbers that we got?
Yes, the banking sector did, okay, for a lack of a better word, with, JP Morgan and Wells Fargo beating analyst expectation with profits, jumping 67% and 57% respectively. These numbers can be deceiving because they've been very conservative, in the past. So these profits look higher than they are. But in terms of expectations, they did just beat expectations, not by a big margin. Hence why the share prices rose. JP Morgan's share price rose 0.6%, while Wells Fargo actually went backwards by 0.3%.
So the kind of thing that I've been quite curious about is that we've been talking about this, fall in U.S. inflation and also looking what's going on with the dollar index. What's the implications of that for equities right now from your perspective?
Well, for now, Mr. Market is basically saying, the markets are going up. If you look at last week, you had the S&P 500 up 2.3% for the week and the NASDAQ up 3.3% for the week, saying basically, the Fed, for the most part, has, inflation under control, and the weakening of the dollar, which, weakened for 5 days in a row before snapping that, today, is testament to, saying, it's risk on, essentially, for a lack of a better word.
You have the SAB having to announce their interest rates this week. Given the fact that we've seen a rise in inflation expectations, some volatility when it comes to the rand, what is your expectation for Thursday's announcement?
Have low expectations, prepare for heartbreak, right? I think I said that at the beginning of last year when, basically our central bank and the SAB announced that, they're going to be increasing interest rates in a very aggressive manner. And, when Lesetja Hanyaho says aggressive, you should take that very seriously. That's what we've seen for the past year. And it looks like for this month, there's going to be no exception because, there's no indication that there will be halting of interest rate increases in South Africa.
So is this month the last hike in the cycle, or are you expecting one more further down the line?
As an optimistic South African, I'd like to think, yes, this is the last one, but I have no idea until they actually come out with the meeting, the announcement, and obviously the notes afterwards. Then maybe we could gauge, what this means for the next few coming months.